Hello and welcome to Policy Watch, your packed snapshot of the week's biggest business stories, their context, their relevance and policy impact. I'm Govindraj, Ethiraj. Now this week saw the announcement of a mega merger of two telecom companies, Vodafone, a multinational, and Idea, part of the Aditya Birla Group. Now estimates say the combined entity will become India's largest mobile phone company with about 400 million consumers, 35% market share and 41% revenue share. Now the industry has been consolidating ever since Reliance's Jio service was launched, which in turn is claiming 100 million customers. Now the question is, will this consolidation be good for customers or consumers, or could it result in an oligopoly, a situation where few players dictate all the terms? On the other hand, how financially viable is the telecom business for consumers to get good quality services over time? To discuss this, I am joined by Ashu Mishra, Associate Director at India Ratings, Suhail Nathani, Managing Partner of law firm ELP, and Alok Shende, Founder of Ascensius Insights, a telecom consulting firm. Thank you all for joining me. So let me begin with you, Ashu. So what does this reflect or say about the health of the industry as we stand today?
Right. See, in India you have multi players competing in telecom sector, whereas globally if you look at the market has been 3 to 4 players. So India, I think consolidation was supposed to happen at some point of time, and Reliance Jio entry probably has accelerated it. So from industry point of view, I think it is good that consolidation.
So what was driving that consolidation before Jio came in?
I mean, the kind of pressure, the competition, which was reflected as well in ROC going down. You had to invest a lot in capex. You probably were not making the kind of.
So you're saying the industry was already in disarray, and the arrival of a new player has obviously hastened.
Just increase the competition a little more.
Right.
So I think from industry point of view, the consolidation is the way going forward. I would expect a little more consolidation to happen, and this would eliminate competition. Probably would bring pricing discipline in the industry, and would also help in.
So when you say pricing discipline, it means for consumers good news or bad news?
I mean, it has dropped to a lot extent. There is more value now being offered for the same kind of price.
Okay.
So from consumer point of view, they'll experience a different. They'll get a different experience now for the same cost they were paying in the past. So and ARPU per consumer has already dropped. So
that's the average revenue per user.
Right. So you would expect it to be stable going forward or probably increase.
Right.
But then the experience you're going to get should compensate the kind of ARPU increase you can.
Right. So Alok, what's your sense when a large player comes in, a market that's already mature? What happens when we look around the world?
Well, there's been no case across the world where someone has come so late in the market. And if you were to take a look at how Indian market has grown, what is really left behind is the bottom of the pyramid consumers. So someone coming so late in the market and making a dent in the market, acquiring leadership position, there's been no case where we can look back and say this is how the markets evolved and this is how someone came by. Though that being said, another aspect of differentiation is that what Reliance is doing is that Jio is doing is that they're coming with a differentiated offering, and what they're trying to do is that veer the direction of the market from pure voice plus data to data-centric dispensation. Now that is something interesting to watch, but just to bring a perspective, it's very late in the market for someone to come and make.
So however they do. So the question here is, what does it do to the market itself? I mean, so far we've seen what it's done to the market. Obviously, it's brought down prices or price discipline, depending on which way you look at it. But what could happen in coming weeks, months?
Well, I think once Reliance Jio starts offering this as a commercial service, that is when we'll know how many are true customers.
Yeah.
Okay. And the second aspect that we'll also start coming to know is that are they retaining high value customers or are they retaining low value customers? The difference is that every operator is vying for the high value customers.
Right. Okay. Got it. So let me bring you in. So in this new order where you have, let's say, one giant player who's become clearly number one, who earlier were number 2 and number 3, and then you have Airtel number 2. So what does this what does this kind of signify, or what could it portend?
What we don't seem to understand is that this is not a traditional telecom market. The tables have been completely turned. The big growth is data. Until Reliance came in, 80% of revenue was voice. That was not a healthy growth because it had taken into account imperfections, high roaming rates, whatever else that you have. Now, you don't pay for voice. You don't pay for roaming. And it's all about data. Globally, the revenue has already shifted to data. It was in India where we had this voice dependency. Now that has changed. And why has that changed? Not the new incumbent or whatever else. It has changed because of technology. Everybody bought 4G licenses. Yes, the bids were high. Some people have not rolled out, whatever it is. Jio came out and has rolled out data and started with data. So quite honestly, their pricing model also, and time will tell, but all it calls upon is for 100 million customers to pay them 303 rupees a month. Is it still viable? To me, it's a no-brainer. Yes, it is, because that's where the battle is now.
Right. Okay. So talking about the battle, but the structure of the market has shifted in the meanwhile, right? So we are talking about it today because we've had a merger. So obviously the ability of, let's say, the Vodafone idea combined to exert some sort of pressure on the market is higher than what it was before as two individual companies. So does that change things?
Well, yes, absolutely, because they're much larger, so that gives them more bandwidth. Hopefully they'll be able to roll out networks faster, they will be able to service debt better, and they will be able to take on competition a lot better. Reliance, by its own statement, is looking to invest 175,000 crores. If you estimate the debt in the telecom market today, this is nearly half that investment is coming in. So, you know, the fact of the matter is that the larger you are, the better you're able to take on.
So, Alok, what's your sense? So, obviously, more money is being spent. There's already, depending on who you ask, over 400,000 crores of debt sitting in the telecom industry. So, could this mean that things could just go wildly out of control at some later point in time?
Well, I think so, yes. What the big quantum of debt means is that there's a strategic vulnerability in all the big operators. And as much as the low pricing regime continues to exist for as long a time, the ability to compete in the market itself could be challenged. So I think that is something that we'll have to wait and watch as to how does it pan out. Okay.
What's your sense, Ashish? How do you see it evolving? I mean, I think we know what the thing is today. I mean, the situation is today. But what could it be in, let's say, a year's time or 2 years' time?
I mean, you know, as everyone knows, significant debt has been added on balance sheet, and the kind of return telecom operators are making, it's not really, very great. So things more from, debt servicing point of view, likely to remain challenging, at least in near term. Over medium term, I would expect, ARPU to increase from the current level, and probably then you'll have slightly better return on capital employed. But then one more point to be highlighted is that every 5 years there has been some event happening in telecom industry. So would you really want to take that kind of bet 3 years, 5 years down the line? That's something very tricky. And people are already starting speaking about new technology coming in.
Right. So you talked about new technologies. Well, you're saying that there's a data bet here. Data in turn represents a slightly more higher generation of technology, 3G, 4G, 5G, now people are talking about. So could all this change the very nature of the market and change the way it brings about stability in the market as well, from a consumer point of view?
Well, from a consumer point of view, what will change is the growth of data. Today, the average consumption of data by a user is 621 megabytes. That's almost non-existent. This growth will be into hundreds of megabytes. So if you see a market, a mature market like the US, an average home uses about 120 gigabytes of data in the house. In India, even per month. Even the high-end houses in India don't use more than 30 gigabyte. So the growth will be from the additional consumption of data, and you're seeing that change in media. So you have Hotstar, you have a whole bunch of platforms, indeed your own...
supply-led video and supply.
Yes, so people are watching TV on their iPads, their mobile phones. I recently met a young kid who has not watched TV or recorded. She doesn't know that this exists. And she said, oh, can you record? That's the generation coming up. It's on demand, it's on the phone, it's when they want it. And that is going to be possible only through data.
Right. So this is a new world. So what does this new world mean from a policy point of view? Does this mean that we need to look at things differently because data is going to drive everything, because consumers have to be maybe protected in some ways?
Well, if you were to take a look at it from the regulation perspective, what, and when I'm talking about regulation, I'm talking about not regulation in isolation, but in how does it affect the industry structure. And I think there need to be a shift in how the regulatory bodies work with the industry, in the sense that on one side we have auctions that happen where there's a very limited supply of spectrum, and artificially the prices are bid up. On other side we have a scenario where incumbents are like under tremendous mountains of debt. Now this cannot sustain for a longer period of time.
Right.
And I think, there need to be, both the regulation and the industry need to co-evolve to something there where there's a greater synergy. Eventually, the consumers benefit with that.
Right. Okay. So, what's your sense? If you were to look ahead, is there some way this whole situation can be managed? So again, we don't end up with large mountains of debt, other NPA problems.
The honest view is that the largest expenditure is not capital; it is the license fees. And gone are the days of absurd bidding now on license fees. The bet will be on technology, and there are two things that drive bandwidth. One is, of course, having more bandwidth, and two is the compression technologies. And as you move into 3G, 4G, 5G, these become better. So on the same pipe, you can push in more data. So there will be investments in technology, and technology you always have to keep updating. But the artificial shortage of bandwidth and these absurd bids, I think the government has seen the glory days gone in terms of high bids for bandwidth.
Right. So, Ashok, what's your outlook? I mean, if you were to look 2 years ahead now, I mean, do you see all of this settling down? And I put this question to you earlier as well, but do you see stability coming in? Is all this a precondition for stability, or is it for more chaos? Let me put it that way.
Yeah, I would expect market to become more rational. Some rationality is also expected from RGO side. They have invested so much money, and they definitely have to make return on it. So I would expect 2 years down the line, things to be more matured and stable.
Okay. Alok?
My anticipation is that before we see a stable regime, the market could undergo through certain degree of instability, for simple reason that when you take a look at the huge investment that Jio has made, and if things don't turn out in the way that they anticipated, they're going to fight back more harder. And the way they're going to fight back is with the pricing power. Now, how that rolls out, how does it pan out, that in turn will decide when are we going to see a stable regime.
Right, and that's something that the regulator, policymaker should be concerned about, or at least be cognizant about. Last word, Sohail.
So, yes, going forward, now it's up to the regulator to make sure that everybody plays fairly. You cannot over-subsidize, you cannot cross-subsidize. Eventually, telecom has to be viable as a standalone business. So there are certain capexes, there are certain bandwidth costs, and that will be passed through to the consumer, but will you allow predatory pricing or irrational pricing, even if it is, under the garb of marketing or whatever else, and how long will you allow it to sustain? I believe sanity will check in pretty quickly, and eventually services will reflect costs. I don't believe the position that India is one of the cheapest telecom markets in the world will change in the very near future.
Right. So you're saying for the consumer, Aam Aadmi, things are going to be fairly lucrative for a while?
Yes, because it's just the output of technology. The better the technology, that's the way of competing.
Right. So it's not just price, but even the quality or the compression, as you said, or the speed, the video, all of that improves.
Yes.
Okay. Thank you very much. We've run out of time. We need to go in for a break. Coming up on the other side, India's primary stock markets are buzzing with activity, with record responses from investors. How should investors, or for that matter, the government, look ahead? Joining me will be Prakash Diwan, Director at Altmount Capital, and V. Jayashankar, Senior Executive Director at Kotak Investment Banking. Stay with us.
Currency Building, Kolkata. A 178-year-old structure, built in 1833 in the Italianate style, with Venetian windows, ornate cast iron gates and railings. The central hall of this building gets light through the sunlight overtoppings in the large domes. This beautiful building was originally the Agra Bank, and then it became the Office of Issue and Exchange of Government Paper Currency. It later housed the Reserve Bank of India until 1937. Today, the building is protected by the Archaeological Survey of India.
welcome back to Policy Watch. The Indian stock markets are buzzing with activity even as they hit lifetime highs. Last week also saw a record response for an initial public offer, a public issue of a Mumbai-based retail chain. As we've been discussing on Policy Watch, there are clear signs that money is flowing back into financial assets from real estate and gold, the preferred destinations for the last decade or so. Even as investors put more money into markets and stock markets, there should also be some caution about choosing wisely and carefully. On the other hand, a vibrant public issue market is a good opportunity for the government to speed up disinvestment of shares in public sector units or banks. To discuss how we should view the market situation and the way forward, we are joined by Prakash Diwan of Altamount Capital and V. Jayashankar, Senior Executive Director at Kotak Investment Banking. Thank you both for joining me. Prakash, let me start with you. So we've obviously had a sort of a great debut by a retail chain. What does this mean when you look at a slightly broader perspective for the markets?
See, I think what this does for Indian IPO or Indian primary markets, essentially is that it scales up the whole thing. I mean, we're talking about size, which is significant. We're no more talking about 200 and 500 crore issues. And then look at the oversubscription, look at the kind of demand. What it also does is, if you see, and you mentioned this briefly, that the government is possibly looking at as a very strong, veritable route to divest. They met the divestment target, but that's been through dividend play. Next year going forward, they could probably look at a lot of divestment, and they need a very vibrant primary market to absorb all that kind of paper. And look at the CPSE ETFs. You've already had 2 subsequent rounds, and both of them have had tremendous response. The third is already announced. So I think what's going to happen is fresh entry of paper, fresh supply of paper is essential for the market to broad base. Real estate is no more kind of absorbing the kind of capital that it did. Secondary markets already are at peak valuations. So you would have a lot of companies seeking the IPO route. You would have a lot of people looking at this. And I think the participation levels through SIPs in the mutual fund circuit is tremendously telling us that there is demand, there is appetite. Right. So this will probably be...
so mutual fund industry is getting almost 4,000 crore a month through SIPs. Yes. Systematic
and that's significant. So, you can imagine if they were to keep on buying the same secondary market paper that's available, stocks that are available, the valuations start kind of getting slightly inhibitive.
Yeah.
So you will have acceptance and appetite for fresh primary issuance, and that's where, everybody is kind of started looking at it very actively.
Right. Okay, so I'm going to come to valuations in a moment. Jayashankar, what's your sense? So what does this tell us, the success of this DMart retail IPO and some of the other IPOs will also seem to be getting a lot of retail interest?
Yeah, so Govind, DMart has truly been a landmark issue. As against an issue size of less than 2,000 crores, we had a demand of 1,40,000 crores. So obviously, investor from every category has come in a very, very huge quantum. In fact, our conversion rate among the FIs and domestic institutional investors was as high as 90% or 95% of the investors that we met. So that kind of tells you the kind of demand that exists for great quality paper. As you know, retail chain is not easy. It's one of the toughest business in the world. But if you do the small things correct and you have a track record and you have a great promoter and a great management team, it kind of shows you the kind of response you can get. And look at the retail. With about 19 lakh retail applications nearly, it's the 3rd highest ever in the history of Indian capital markets. So I think there is a fairly large pool of money available, and I think that really augurs well. And we saw this right through the year. We are involved in about 10 or 11 IPOs in the last fiscal year. And if you look at the overall returns given by IPO companies and compared with Sensex, I think the IPO companies have outperformed the Sensex by a good 20 to 25%. So that kind of tells you that issuers have also been pretty judicious when it comes to pricing. Investors have also been discerning, because this time around, unlike the previous capital market runs, I think it's been high quality paper that's been coming in. Investors have pushed back on paper where valuation is a suspect, and we have seen those IPOs really struggle. So it's a very healthy capital market where good quality paper, right valuations, and investors are making money.
Right. So, Jayashankar, the demand that you talked about, you said that, there were almost 9 million retail investors. It's the 3rd highest. Now, does that mean that these are retail investors who are, in a way, awaiting something like this? Or could it also be that there's an element of, a big gamble or a big punt, which also may not be very healthy for the market?
See, one thing, Govind, that I've noticed in the last 2 years clearly, if you look at a DMart, which had about 19 lakh retail applications, if you look at a Dr. Lal, SH Kelkar, you look at Ujjivan, Equitas, PNB Housing, then RBL, and quite a few other transactions, where both retail and institutional investors really flock to these IPOs, you would find that investors have generally made money. So that's why I'm saying this bull market run, or rather the great run that we are seeing in the capital market, is qualitatively very different from what you saw in 2007, 2008, where a lot of companies perhaps disappointed. Whereas in this bull market run, investors are being very discerning. The retail investor is picking the cue from the quality of anchor investors, so they are not coming in blindly. And we are seeing a good correlation between retail response and the quality of institutional response.
Okay. Prakash, are you in consonance with that? I mean, we are seeing a healthy flow of institutional retail. People are more discerning, careful.
I would believe, yes, institutional, yes, is naturally much more well informed and aware, but I would believe retail still gets carried away by a lot of hype and you know, these numbers, as you mentioned in this particular DMart issue. But what's important is there are two types of IPOs that you need to look at. The market is very clear. One is fresh capital formation, fresh issuance of capital. The other is OFS. My worry is that wherever, you know,
offer for sale.
Yeah, offer for sale. So where, you know, promoters or existing investors are diluting. Now that could happen at times where valuations are attractive. Remember one thing, in an IPO, it's the issuer who knows best. As a buyer of an IPO, I am not at an advantage. Okay, the price discovery could go either ways. But knowing the fact that if it's an OFS, the promoter knows the business better than any of us, and if he or she is issuing it at a particular price, there's not much of money that you could make unless you believe that there is growth also beyond that. So I would prefer look at IPOs and as an environment, it's much more healthier if you have fresh capital formation happening. And that's what happened for the last few years. So given the fact that if the economy turns around and if there is capex from the private sector, only then you need fresh issuance. And that is the real stuff that you need to look at in IPOs, not OFS. OFS is opportunistic. It could happen when valuations are at a peak.
Right.
So that distinction people need to understand.
Make very clearly. Yeah. But having said that, I mean, obviously there was a demand, whether it was an offer for sale or whether it was going into actually investing into the company's growth. But there was clear demand for.
Yes, there is demand. There is demand for good businesses which people have been waiting. They've seen the proof of the pudding. The numbers very clearly are strong. So people want to participate in that. And it's happened through the year. I mean, some quality IPOs have been not only waited upon but have seen those kind of responses. DMart probably being more recent as we recall.
So to that extent, was this a one-off, or what do you think it's?
No, I think it's the beginning of a lot of sound businesses which will hit the market. It will be setting that trend. It's also proven the fact that if you run a business well, wait patiently, time yourself in terms of entering into the market, you will get this kind of response.
Right. Jay Shankar, what's your sense? If going forward, should people, including the government who would be looking at divestments, tread carefully or, try and move quickly because this is an opportunity to be grabbed? I'm talking about the demand, particularly from retail investors.
So looking ahead for the next fiscal year, I'm seeing supply on the IPO market probably going up by at least 50%. So last calendar year, for example, collectively the money mobilized was about 26,000 crores. As I see today, I think the pipeline is indicating a good 40,000 crores to be raised in the current calendar year. If you look at the QIP market, the whole of last year saw only about 6,500 crores being raised, where the first quarter of this year we are probably seeing that amount being achieved. So I would say the QIP market will probably be about 4 times the size of last year. So put these together, and you also have the Government of India disinvestment. You're hearing about the general reinsurance companies and the general insurance companies going public. I think there's a great amount of supply, and most of these companies, believe me, are high quality companies. So I have no doubt in my mind that investors will qualitatively make the same kind of returns that you have seen in the last couple of years. From a supply side, as one of you were observing, there's a pretty strong inflow into the mutual fund industry. If you look at the SIPs and you kind of extrapolate for the full year, the flow into the mutual fund industry can be as high as $10 billion plus. And the FI flow, if you just go by what we have seen in the last couple of months, the stability for the BJP government, the reform agenda, the GST bill getting passed, all this will probably ensure that we benefit disproportionately compared to other emerging markets. And if you see somewhere about $15 billion of FI money coming in, and $15 billion, believe me, is probably not the highest in the last 5 years. It will probably still be the third largest flow.
And what's your sense, Jaishankar? I mean, would specific companies benefit more? Specific kinds of companies benefit more, or do you think the environment or the mood is such that it could really, start? I mean, money could come into any company which seems good enough.
No, Govind, as I said, this is qualitatively a very superior capital market. Investors are discerning, bankers also are doing their fair bit of diligence. So we do not see the euphoria of 2007-8 really playing all over again. You're only going to see growth companies, companies that create value coming to the market and raising money. You look at the last 2 years and that kind of bears what I'm saying. And as I look at the pipeline, it continues to be the same high quality companies coming to the market.
What's your sense, if you were to look ahead, should people be careful? Should people be, those who are watching us today, for instance?
I don't think yet we are into that zone where, we're closer to a bubble or something.
Right,
DMart was a very well-known business, backed by a lot of strong pedigree. But I think going forward, you will have a lot of appetite for new businesses. Let's say the BFSI vertical. We've seen MFI institutions come up with the IPOs. We'll see more of that. You see housing finance. So these are areas which are capital intensive. So people should look at things which need capital and they come to the market, do it for the right reasons, and not just somebody who's diluting because the business has been running well till now and the market's offering a very sound valuation. So I would only make that distinction that, especially if it's offer for sale, be slightly careful and evaluate why somebody is exiting. And if it's the promoters who are exiting, I would dig a bit deeper into it.
Okay, got it. Last word, Jayashankar, your outlook for the next year and any words of caution?
Before I come to that, Govind, just one particular point I would like to make. See, if you look at issuances like, say, Mahanar Gas or Dr. Lal, which are 100% offer for sale, investors receive these IPO extremely well and they're given fantastic returns in the zone of 30% to 80%. It's not that always the greed of the selling shareholders overtakes and you kind of end up mispricing. So these are two fantastic examples of 100% offer for sale, great returns, great deal for both the investors as well as the selling shareholders. Secondly, I'm not seeing too many promoters selling. So when you see the secondary comment in many issues, it's mainly because either the private equity investor is selling or the government is selling. We are not seeing too much of government paper on the IPO side. So at this point in time, I'm not too concerned by the mix of primary and secondary. And frankly, when we speak to the institutional investors, they love companies that don't need capital. They want growth companies that are well funded and they are not really too perturbed about whether it's a growth capital going to the company or it's an offer for sale. So I just wanted to kind of make that point because we've seen several successes on that front. I do take the point of my co-panelist that there can be situations where just the greed of an investor, especially someone who's exiting 100%, will that kind of overweigh on valuation? That's a fair concern, but we are not seeing too many of those instances. Investors have monetized only partly, call it 20%, 30%. But rarely I see someone
unfortunately, I have to
100%.
interrupt you. We've run out of time completely. Thank you so much for joining me. But the points are taken that we're looking at a fairly healthy capital market, which is in some ways feeding good quality companies that are coming in. And broadly, as both of you have said, the markets or the investors are far more discerning. But nevertheless, you should always be careful. That's a good note to end on. Thank you so much, Prakash and Jayashankar. We've run out of time on Policy Watch. We'll be back next week, same time. Thanks for watching.